Good afternoon in Asia, good morning in Europe and corresponding time zones. Welcome to this webinar on conversations on central banking, organized by the Master of Central Banking group at the Asia School of Business. My name is Hans Genberg. I'm a professor of economics at ASB, and I have the honor and privilege to moderate this panel discussion in this webinar, which will explore issues of green finance and central banking. Now, there's no doubt, I think, and little disagreement that climate change is one of the major challenges facing policymakers and societies more generally at this time. How we deal with this issue of climate change challenges will help determine the nature of the world that we will leave for future generations. The ultimate objective, to use some central banking jargon, is, of course, policies and habit changes to prevent climate change from leading to an irreversible deterioration of living conditions on our planet. Green finance is, to continue with the central banking jargon, is the intermediate target in this context. If our financial markets develop in such a way as to promote investments in technologies and manufacturing processes that are climate friendly, this will contribute to a more sustainable global economic development. While I believe there is no serious disagreement about the importance of addressing climate change issues, there's less unanimity about the role of central banks in doing so. On the one hand, Chairman Powell of the Fed has recently stated, and I quote, "Climate change is an important issue, but not principally for the Fed," end of quote. While the Bank of England, for example, has climate change concerns added to its mandate. Now, so what should the role of central banking be in green finance? To help us think about these issues and questions, we have two eminently qualified panelists with us today, Dr. Sabine Mauderer from the Deutsche Bundesbank and Dr. Philipp Hildebrand from Blackrock. Dr. Mauderer has been member of the executive board of the Deutsche Bundesbank since September 2018. She's responsible for the Directorate Markets and Human Resources. Additionally, she's a member of the Exchange Experts Commission, the Central Capital Market Committee, and the Steering Committee of the Central Banks and a Supervisors Network for Greening of Financial System, the NGFS. Prior to her current responsibilities, she held several positions at the KfW banking group. This is the German development bank, it's a state-owned development bank and one of the largest development banks, national development banks in the world. In KfW, she was head of many sectors, banking sector restructuring, head of auditing and risk management, among others. She has a PhD from Osnabrück University. Philipp Hildebrand, Dr. Philipp Hildebrand, the former chairman of the Swiss National Bank, is currently vice chairman of Blackrock and a member of the firm's Global Executive Committee. Philipp has served as a visiting fellow at Oxford University's Blackrock School of Government, and he sits on the school's International Advisory Board. He served as chairman of the governing board of the Swiss National Bank in 2012. In that category, he was director of the Bank for International Settlement, the Swiss governor of the International Monetary Fund, and a member of the Financial Stability Board. He received the Central Banker of the Year award in Europe from the Banker in 2012. Philip is a member of the Group of 30 and an honorary fellow of the Lincoln College, Oxford, and he earned a PhD from the Oxford University in 1994. So I would now like to ask each of our two panelists to give brief introductory remarks, after which we'll carry on a conversation where you in the audience will have the opportunity to ask questions in the Q&A box. So without further ado, can I ask Sabine to start and give her opening remarks, please?
Yeah, thank you, Hans. Do you hear me very well?
Yes, yes.
Perfect. Yeah. Yeah, thank you first of all for inviting me to speak to you and obviously to a lot of younger people who are interested in central banking. I know that especially for the younger or middle-aged generation, climate change is a very important and driving topic. And I think it is a perfect topic to raise here in this place. What is actually the role of central banks in this regard? Is it at all something central banks have to care about? And if so, how, what is their precise task in this regard? This is the question I asked myself, I think 2.5 years ago, where I heard, no, our mandate is price stability, and this has nothing to do with climate change, right? And to be honest, it took me really a couple of months to think of, okay, what is that really something central banks have to deal with? And the answer is clearly yes. It's something everybody or every institution has to play a role. And what I would like to highlight here in my introductory statement is what is actually our precise role. Well, as Hans said, climate change is for us human beings probably one of the most, if not the most threatening development globally. So it is clear that everybody of us has to, play its role, take over its responsibility. So it is about the process, and we all know that, of transformation, transformation to a hopefully carbon neutral planet by 2050. So we know that this transformation needs, public decisions, but also engagement from the private side. So what I really would like to highlight that it is a public-private partnership. So the private sector, and I'm pretty sure that Philipp will also talk about the private side, has also a crucial role. But let me, since I'm representing the public sector today, also, or focus rather on the responsibilities of the public side. Well, I mean, we all agree that central banking is not about climate policy or public policy. It is clear that we do have our mandates, that most of our mandates are have the prior mandate for price stability and not for public policy. So let me start with who has to do what within the public sector. I think the most important signal that the market needs to get transformed is the price signal. And this price signal, so that CO2 or any other kind of harmed emission has a cost, right? Has a price, a high price. And reflects the externalities, right? That is crucial. And this price setting needs to be done by elected governments. And that's what I really, I'm waiting for, is to have at least at a certain global level agreed on a carbon tax that is sufficient to, to give the right signals toward the market, that we expect them to, pave the way for the transition towards, carbon neutral industry by 2050. So having said that, I mean, I could continue what I also think is important from what I expect from governments, like, regulation, like disclosure rules to, get all those information and data, especially from the real economy, that really actually shows who is really, where's the brown or carbon incentive industry. So this is something, if you ask me, besides of carbon tax, disclosure is for me also the second most important thing. So this is the role. It's not, it's not limited for only those two things, but I could, use up 2 hours to speak about the role of the government. But we are here today to reflect also the role of the central banking in this area. So I started with, okay, what is not our task? But I think it's also crucial to think, okay, what is our responsibility? And maybe I put it in one way, our main responsibility is to use our extensive analytical capacity and competencies to address the urgency of the political decisions. What does that mean? What I think is crucial, and that's my daily, my daily business, is I'm also in touch with governmental bodies, with ministries and so on. And I'm sometimes a little bit worried that this awareness of not just, agreeing on the goal to be carbon neutral by 2050, but the way, so how we are going to get there. This is something where I, from time to time, have the feeling, okay, there is much, the awareness that this is a really big thing we have to start now is not there. So I think the major task and responsibility of central banks is to play here its role in, really arising this awareness of showing, due to our analytical capacities, what will happen, to really show within analytical scenarios, or we do call it scenario analysis, what happens if we do not change right now. Our studies show that we will probably have a global earth warming between 3.5 and 5 degrees, what is unbearable. What happens if we do something but too little and too late, right? And the third scenario we are currently working at is, okay, how would it look like if we deal with an orderly transition to enable the economy or the planet to only allow Earth warming by 1.5 up to 2 degrees, right? Okay. So what I'm always been asked is, okay, so but where is room within our mandate to do exactly this? Well, this is, I think, one of our core competencies and also mandate, right? Many of us, and there I think is the real focus for central banks is financial stability. Financial stability, is much about the financial risk we are seeing here. We see that climate change is a new source of financial risk. And these financial risk, we talk usually about two kinds of risk. Here we have the transitional risk and the physical risk. And this is something we deal with in the financial stability mandate. So let me just explain briefly what I mean by those two kind of risks. The physical risk is very easy one. You have wildfires, you have droughts and so on. And, all those losses you see due to this event are the physical risks. So they are already enormous. To me, the much bigger threat is the so-called transitional risk. This is the risk if governments globally do not act at all or too late. And then all of a sudden we realize, maybe within the next 8 to 10 years, oh my God, we really have to do something because we are already facing, the results of climate change, and this is a real threat for health and for the planet as well. And then you see, massive regulation and probably laws that will not allow or will, threaten a lot of industries or business model of bigger companies. And so this risk we call transitional risk. That means that the governmental decisions are coming too little or too late, right? Okay, maybe just to summarize in which other areas I see sustainable finances or climate change as one of a task within central bank's mandate is. So I started to talk about financial stability. Let me just briefly come to monetary policy. Monetary policy will be affected because, of course, we see, a price dynamic. We see, inflation will be affected. CO2 prices, we see this here now in Germany, that it has an impact on price dynamics. We probably, see in those islands who are already, experience the outcome of climate change, that housing prices develop in a different way. And we have so many things that will be affected by climate change, that also monetary policy and its key parameters will be affected. So what we are currently doing is also to redo our models, because so far we have a different time horizon. We do not have the medium to long-term time horizons. Neither we do have this in financial stability, nor we do have this in monetary policy. So what we currently try to do is to reflect this long-term risk or medium-term risk also in our models. Maybe the final word, because this has to do with monetary policy, is, and you see this really often in the media, and therefore I would like to reflect that, how about the balance sheets, the operational framework of central banks? And this is especially important since, the balance sheets of central banks have, expanded massively due to our asset purchase programs. And now the public and a lot of NGOs complaining about the carbon footprint of central banks, because what they say is, okay, you have oil companies, assets of oil companies on your balance sheet and others, and this cannot be, right? So this is something where we are, under scrutiny, and it's up to central banks also to, to find a solution with that. What maybe just a final word, because that gets a little bit too deep into the subject, but what we do in the Eurozone is we try to think of, okay, climate change or ecological issues are a new source of financial risk, and we do have to integrate this new kind of risk also in our risk management. So what we currently do is to think of how we going to integrate climate change into our risk management. So also to think of how we're going to answer to, the collateral framework, and also to the asset purchase program. Maybe just to the last point, where I also see a task of central banks is for those who have banking supervision within their mandate, they are also affected. And here is the task of the supervision area or unit to ensure that climate change risk or any other kind of ecological risk is reflected in their management, in their balance sheet and risk management of the financial industry. Yeah, so I leave it with that, and I'm more than happy to answer all kind of questions. Thank you.
Thank you very much. I thought it was particularly interesting to your argument that central banks have the analytical capacity to think about these issues, perhaps more so than other government agencies, and that's a big role for central banks in this process. May I now turn to Philipp to give his introductory remarks, please.
Sure. I hope you can hear me. Thank you very much, Hans, for having me. It's wonderful to be on this panel with Sabine, and seeing so many of my old friends and colleagues makes me realize how much I love being a central banker. But there is life after central banking, for those of you who wonder, so I'm a testimony to that. And life is quite exciting at the moment in this space of what I would call the interface of capital markets, governments, and climate change. And in some ways, it's perhaps not entirely what one would have expected, that post-COVID we would see an acceleration, or with COVID, an acceleration of the focus on climate change and the transition to net zero. And I want to start with where, in a way, Sabine started. The critical piece of all of this is government commitment. later expressed, of course, in government policy, carbon pricing, transition plan requirements, disclosure requirements, etc. And this is the part that COVID has, perhaps paradoxically, perhaps not, that's a different topic, but has actually accelerated. We are now seeing, and I want to start with that and then get to the capital markets. We have 127 countries worldwide that have now committed to net zero targets by mid-century. I don't think I step on anybody's toes if I say here that most of them probably have no idea how to get there at the moment. Nonetheless, the fact that these commitments are made by China, by the US, by Europe with the Green Deal, by the UK with the 10-point plan, and by many others, of course, is extremely meaningful. And the world is noticing, and capital markets are noticing. I think that's the key. What is also becoming clear as people study this, what does it actually mean to get to net zero? We're beginning to realize that this transition journey over decades will be nothing less than the most significant transformation of the global economy and in many ways global society that we have ever undergone, certainly since industrialization. If you think about what it means to decarbonize, right now we're focused on the energy sector. That's in a way the sort of first round. And by the way, a lot of this intellectual discussion started with the central banking pointing to the fact that there are a lot of stranded assets in a lot of balance sheets all over the world. When Mark Carney gave his speech, I believe in around 2017, pointing to this problem. But if you think about the transition, it goes far beyond the energy sector. We will have to transform the construction sector, the steel sector, the shipping sector, personal transportation sector, agriculture, which perhaps will turn out to be the most challenging, at least conceptually. So you can see that what is going to happen here if we're going to reach these targets, and as Sabine said, we're a long way away from it at the moment, it will mean an unbelievable transition of every system that makes up the global economy. Everything will be impacted by this. Countries, policies, sectors, companies, and of course, we as individuals in most cases will also be impacted. For some, it'll be very adverse. For some, it'll be an incredible opportunity. We've seen some of this as a flavor through the pandemic when you think of how the health sector has benefited, or even more dramatically, the tech sector, when you look at some of the valuations, some of the stock price changes, some of the profitability numbers of the tech companies that have benefited so dramatically from the effects, from the transformation, if you like, that the pandemic has triggered. So this will be a wholesale transformation of the global economy. And this is where I come to the capital markets. The reason why this is such an exciting moment, and I think a hopeful moment, is because of the commitments from governments, which for the time being are taken as credible, even if they lack details. And the US pivot has been a very important piece of this, of course. And the fact that people are beginning to realize what this transformation actually means in terms of scope, this historic transformation, capital markets are waking up to this. Why are they waking up? They're waking up because they realize these tremendous impacts that these transformations, or this overall holistic transformation, will have on pricing, on relative pricing, on valuations of companies, of sectors, of entire economies. And they're beginning to realize that a very simple principle, that climate risk is investment risk. And this is how we have tried to summarize our call to action at Blackrock, who happens to be the largest shareholder in the world. We own thousands and thousands of companies, anywhere from 2, 3, 4 to 15, 20% holdings. And so we feel it is our fiduciary duty, apart from our personal views on this, to draw attention to the fact, to these companies where we are shareholders on behalf of our clients, that they need to wake up to what's going to happen in terms of, most simply put, tremendous relative changes in prices and in valuations as this transformation takes hold. I should add one point here that we pointed out together with a couple of other central bankers and ex-central bankers in a recent Group of 30 report, again, to re-emphasize the point Sabine started with. At the outset of all of this, there has to be a credible commitment by governments. If that were to fall by the wayside, it's hard to see what's going to happen here. But at the moment, as I said, the good news is that commitment is taken as credible. So financial institutions are waking up. They're beginning to realize that if they miss this, it could have adverse implications. The fact that societies are waking up, the fact that we have young people, many of you on the call presumably are much younger than we are, have clearly a different utility function going forward for what they see as important and not important, perhaps a different value system. The fact that Greta has called us to action and all her youthful colleagues some years ago, the fact that clearly our own kids are pushing us at home, all that, of course, is part of why governments have shifted, together with the physical manifestation of climate change, the wildfires in Australia. Glenn can say something about this, the flooding in California, the heat waves, etc. You can also see that these natural manifestations of climate change are having impact on utilities. In the case of the United States, there have been bankruptcies. These bankruptcies have led to changes in spreads of other utilities that have not yet been directly affected by climate change. So the physical manifestations that we've seen in recent years has actually been a laboratory, in a sense, a test case of the fact that this changes relative pricing. So capital markets have woken up. And, it used to be, I come from a country where sustainable investing has been a kind of a niche piece of the financial sector for quite some time. But the principle was always, if you do this, you have to give up returns. So there was a kind of value for values trade that you had to make if you wanted to invest sustainably. We're now realizing that was completely wrong as a framework, as an intellectual framework, because it sort of compared, the benchmark was a world where climate change didn't exist. That is a completely flawed framework. What we need to think about as investors is the benchmark is a world where climate change exists and nothing is done about it. And that, of course, produces dramatic figures when you think about the implications on GDP and on valuations. I'll give you just some simple numbers. We've done a lot of work on this, and it's important to have these in mind. If no climate change mitigation measures were taken over the next years, given what we know today about the science of climate change, we estimate that we would see a cumulative loss in output globally of 25% over the next 20 years. That's a quarter of the world economy. We then tried to break this down into sectoral implications. And of course, what you can see is it has dramatic implications either on the upside or the downside on different sectors. And so all this has led the capital markets to wake up, the corporate boards to wake up. They realize they have to move. They're being pushed by people like us to say, we're your investor on behalf of our clients. We don't want the valuation of your company to be diminished by a quarter or perhaps more if you don't respond to these changes. So please come up with a plan on how you're going to adapt your business model in the face of the challenge of transition to net zero. So the combination of regulatory pressure, shareholder pressure, societal pressure has meant that capital markets are waking up. And I can just perhaps close with some, of course, anecdotal evidence. Nonetheless, Blackrock is now the size where, in many ways, we're kind of a microcosm of the global economy. And when I look at the shift in preferences from our clients, the pace at which they're shifting from traditional ETFs, for instance, in the index space, to the sustainable ETFs that we have launched as alternatives for our clients is quite extraordinary. But we have launched in the last 2 years over 150 almost sustainable ETFs. And we've seen a tremendous shift in capital, a reallocation of capital from traditional ETFs that would not have worried about climate change to these new ETFs that take climate change into account and try to weigh the holdings accordingly. So it's a clear sign. Hundreds of billions, just within BlackRock, hundreds of billions of dollars have shifted towards climate change attuned investment strategies. Now, our job is going to be as aggressive as we can be, as forward-leaning as we can be in providing choice to our clients. And I have no doubt that we're at the very beginning, Hans, of what I would call a seismic reallocation of capital in response to these climate change considerations. And, I'll end with a sort of slightly perhaps cynical note, but I come originally from the private side, from capital markets, went to central banking. I'm back now in the markets. So I have no illusion about how markets and how market operators operate. And let me let you in on the secret. It's very basic. When they smell an opportunity and they see a risk, they move, and they move quickly. And the risks here and the opportunities are so significant that I have no doubt that we're going to see a tremendous reallocation of capital. And you can see this happening in the corporate boards. You can see it happening in the markets. It's the beginning of a historic shift of capital. And the reason it's historic and will be sustained and large is because they're seeing the implications. And once they see the movement of capital, they jump on it. So much of what happens in capital markets is one gigantic momentum trade, if I can call it that. And there are now many people in this business who may have no view on climate change. They may even have the opposite view of all of us, presumably. But I guarantee you, when they start to see capital moving and they see the magnitude of this reallocation of capital, we will see the capital move. And finally, central banks, of course, are a part of the capital market. So the notion that somehow they can take themselves out of this is ridiculous. Of course, it's not part of their core mandate. Of course, that's not their job, and nor can they solve it. But I 100% agree with Sabine that you cannot make the case as a central banker that this is not your problem, that you're unaffected by this, and you don't need to think about what it implies for your regulatory activities, for your activities as a reserve holder, and for your activities as a liquidity provider, given the historic and seismic nature and scope of this transformation. Thank you, Hans.
Thank you, Philip. Very, very important insights from the capital market, the private sector point of view. I have some questions, but I see in the chat box, Patrick Conahan has a question. Why don't you articulate it yourself, Patrick?
Sure. Thank you, and thanks to the speakers for really interesting presentations. I mean, I really welcome particularly what Sabine said about central banks getting more involved and aware of climate change issues in their policies and in their analysis. And the only question I want to raise is the following one. The general public thinks that central banks are, amazingly powerful. Saved the world in 2008. Maybe saved the world again last March when the financial markets panicked, the dash for cash. So it seems like central banks can do anything if only they will go and spend some money. But I think we know here that there are a limited number of things that central banks can do to affect climate change. They're important, but they're limited. Yes, imposing better risk management and climate change risk requirements on supervised financial entities. Yes, get a climate change filter in the asset purchase programs or the or collateral frameworks. These can all make a difference, but the difference is probably fairly small. And I know that I know that some research has suggested that if, for example, the bonds of climate, heavy companies were excluded from the purchases of the European Central Bank, that it might make a difference of 10 or 20 basis points in their cost of funding. So it's not going to change. It's not really going to change the availability or materially the cost of financing. And what I worry about a little bit is that there might be part of why central banks are getting involved in this is because they want to retain the trust of the general public. The general public is now concerned about climate change, and they want to make sure that their central banks are looking after the climate change issues. And if central banks cannot actually deliver very much, will there be a huge disappointment? Or was it only talk? How can expectations be managed around this? A lot of talk from central banks now. Are they talking too much?
Sabine, do you have a view?
Yes, and you hear me sighing, because this is exactly what I have discussed with so many central bankers within the last weeks. Because what we now see is, and that's a phenomenon you, Patrick, raised, is that the NGOs are not having all their posters that we are killers at the governmental buildings, but now at the central bank's buildings, right? Bank of England was a big, poster saying, here are the killers, the ECB the same. And so, and one can ask, so what's that? We do more than all of the governments together, and why is this impression that we are killers, right? And I think this is exactly what you raised. Is the thing is that there is, a misunderstanding of our role and of what, I think not only of our role, but of the way, of our impact. And that's what Philipp completely right said. Well, we do not have to underestimate the role of the central banks, especially, as I said, I see it in, analytical competency and, getting in touch with our local governments and really, pushing that. We need to see, price signals. As Philipp said, this is the only language the market understands, right? So we do have a role. And certainly, as you said, well, if you now divest from certain assets, of course, this is also, from a risk perspective, this is probably useful. But what I'm always addressing is, coming to the Euro system, 85 to 95% of our portfolio is governmentals, governmental bonds. And, and we are talking about a portfolio of 10 to 15%, this is corporate bonds or other private assets, right? So, and we are only always being asked and threatened by, please divest from this smaller part of private bonds, right? But the real threat actually is from the governmental bonds, and this is something, the awareness in the public is not there. But, to sum up, I think it's very important that we are very cautious when we communicate about what is our role, where are our limits, and actually being, to explain to the public our task, our responsibilities, but also our limits. And this is really that's really difficult because, especially my institution has been under critics for, in the Financial Times and others, because the governor addressed the limits of the task or even the impact that central banks can play. And this has brought a tremendous negative, media communication. And on the so one has to be very careful about communication and expectation management. But let me just finalize with this important sentence: we have to play our role. This is something where we really have to do something.
Thank you, Philipp. Do you have a view on this issue?
Yeah, just look, the divesting narrative is complicated, and it's a hard one to own. I think we have, and this is not just the central banks, but I would say generally asset holders and even asset managers have not done a good enough job in terms of trying to own the narrative around divesting. Divesting is part of the transition, I have no doubt. So for instance, we have divested where we could out of thermal coal. There is no economic case for coal in this transition if you believe the commitments by the governments. On the other hand, just exiting out of all holdings, fossil fuel holdings, just doesn't solve the problem. The economy cannot exist today in the short term without fossil fuel. So by definition, a complete divesting out of it would simply not work. And so there is a kind of a point on a curve, if you think about it. There's an optimal combination of transitioning and divesting. And I know we're working on trying to kind of publishing a paper sometime later this year around COP that tries to really put a robust intellectual framework around the divesting story. I had a discussion with Bill McKibben the other day, one of the most prominent environmentalists, and even he agreed on the call that there is some kind of combination of transitioning and divesting that is optimal for how we get to net zero. That will not satisfy those that want us to get out of all fossil fuel right away, but that doesn't work. And by the way, a lot of the expertise around how we're going to solve these problems technologically resides in the energy sector. And so we need these companies to be part of the transition. And if you simply kind of took the extreme divesting logic, these companies would just cease to exist. And so, but I think, central banks and asset owners, asset managers generally have not done a good job trying to own the narrative around divesting. And so that's something we have to work on in the months to come. We can't just leave that debate to the activists who say, get out of everything right away, because it's just not realistic. My sense is the pandemic might help us because we have seen what happens when you shut down an economy right away. We've now seen it. We've seen hits to GDP of 30, 40%. And so we know that's not an option societally, politically, and transition is the way to go. And then we can have debates as to what shape the transition will take.
Thank you. Glenn Stevens, you had a question in the chat box about uncertainty and expertise of central bank decision making. You want to elaborate?
Yeah, sure, Hans. I think one thing is I listened to the speakers talking about central bank's analytical capacity and the need to kind of mobilize that to help in the discussion here. And I think this builds a little bit on the point Philipp was just making. There's kind of a trade-off or a sequence of trade-offs we need to make on this path of transition, rather than go, all the way to one extreme immediately. So central banks, probably the degree of expertise in climate modeling and so on is going to vary between central banks. But one thing that all central banks do think about a lot and have a lot of deep experiences is in the process of how you make a decision under uncertainty and with imperfect information, both uncertainty about the outlook and uncertainty to some extent about how effective your policy instruments are. So I just wondered whether that process of how you go about making such decisions, is this an area where central bank experience can be brought to bear to help elected governments and maybe capital market participants as well, but certainly elected governments in how they grapple with this? Because the uncertainty, given the timescales that we're talking about, are massive. And I can imagine that it's bewildering for your average politician to even grasp how you think about this. So it just occurred to me that maybe is something that central banks can kind of assist with, given decision making under uncertainty and imperfect information is something they do every month.
I presume that's also done in the private sector, Philip.
Yes. So
who has the most expertise?
Well, central banks have unique expertise in analytical capabilities, and I would definitely think that's one area. The other area I would see, Glenn, is just trying to help model and get a sense of the implications of this capital reallocation in line with whatever transition path we settle on, and what that will mean with regard to relative price changes and implications on sectors, on entire economies. Because the more clarity we have, the more capital we will reallocate. And this reallocation of private capital is key. And if the central banks can help support the kind of clarity through good analytics, I think it's very important. No matter how much, and we have now activated historically kind of unique, fiscal numbers, but let's just be clear, no matter how much a commitment governments make, public money will never be enough to fund the climate transition, right? I mean, the numbers are out there. It's a wide range, lots of uncertainty, as Glenn says, but we need somewhere between $3 and $6 trillion per year for decades. No amount of, policy revolution, no amount of zero interest rates, no amount of debt generation can generate that kind of capital purely from the public side. So the key to all this is massive, large-scale, rapid mobilization of private capital. And the more clarity we have on what the transition means, the easier it will be to mobilize that private capital. And that's, I think, where central banks could also play a role in modeling the kind of impact of the transit of various transition paths onto relative price changes. What does that mean? That will give markets more of a path to mobilize that capital.
Sabine, you mentioned in your introductory remarks sort of scenario analysis that you were conducting at the Bundesbank. Maybe you can relate that to Glenn's question. And also, I would like to ask you what is the work of the NGFS, the network of central banks in this area? What do you do, so to speak?
Yeah, maybe I start with that one, Hans. So I don't know whether some of you have heard of this network. This is a network of central banks and banking supervisions that was founded 3 years ago with only 8 members. Bundesbank was amongst them, Singapore, China, Banque de France, and the Netherlands were also the founders. And why did we found or set up this network of the willing? It's because 3 years ago, and it's still the same, we realized that this is a global threat and we have no clue about it, right? So we said, okay, how are we going to do that? And the thing is about, put our knowledge together, work out where is the beef and what is the most striking thing, and how we going to share the workload and the analytical capacity globally. And we have been quite successful because starting only 3 years ago with 8 members, we are now over more than 90 members, central banks and banking supervisions globally. All continents are represented. And so what do we do there? We do different things. And one, what I think is the most important, and this is what Philipp also referred to, is currently we are in the middle of the process of modeling different scenario or doing a scenario analysis. So in analysis with all our members, so with all of the jurisdictions we have represented in our network, is we have different scenarios, so not back-looking. The models, we used before are rather backlooking and looking and have a different, a time horizon. And furthermore, in our existing models, we do not reflect risk like transitional risk, all those uncertainties that Glenn was referring to. So what we do is that we are now creating 3 to 4 different scenarios. First on the global level, then now we have started to narrow it down to national jurisdictions. So what happens if the government does nothing or nothing more than now? What happens if there is only little and too late? And what happens if they start right now to get prepared for an orderly transition that allows us to not exceed 1.5 or 2 degrees earth warming? And the whole thing is about showing the impact on the economy with these different scenarios, and containing all uncertainties or reflecting those uncertainties as much as we can, right? And that was absolutely the right remark. This is something we are experienced with, right? But I must admit, all the other stuff, the new kind of risk and forward looking with those new time horizon, that's also for everybody of us very, challenging and new, right?
Hans, you're on mute.
Yes, sorry. I want to raise a question that's related to, I guess it's related to divesting. And that's a question, how there are issues raised in the press from time to time about how you determine whether an asset is really green, and that sort of monitoring. Is that a big problem, or is that something that's being solved, and who should solve it, and so on?
Maybe I start, and then the expert is definitely Philipp, but maybe I start. I think the main thing is to start with, it's not about green assets. It's not about assets that are already or reflecting a green niche or green part, sustainable part of the economy. It's about, managing to pave the way for the whole economy. But it's about the transition. So I always, when I have my brokers here and they say, well, Ms. Mauderer, there are no green bonds, right? I say, it's not about the green bonds. It's about, allowing our portfolio the transition, right? To finance the transition, right? In our own portfolio, not in the monetary policy portfolio. So I think this is a very important thing. And we see the first, transitional bonds, there's no framework so far. But I think this is something we have to bear in mind, that we allow, the economy to transform within a given time to net zero.
Yeah, I would say that's exactly right. And that was the problem with I won't go into details, but the EU taxonomy, as it was originally articulated, was very helpful, because for the first time you had some regulatory clarity on what is a green asset and what is not a green asset. But by design, it couldn't cope with what Sabine just described. You were either green or you were not green. And as a result, the green part was quite small and could never cope with the kind of capital mobilization that we need for the transition. So you're exactly right, Sabine. And the answer, I think, Hans, the way you do it is you have to start to say, where is an asset today or a portfolio, and where does it need to get to by, let's say, 2050, since that seems to be the benchmark, the Paris-aligned benchmark that we're all taking. And this becomes then very quickly a very complex analytical, perhaps central banks have something to do here, analytical problem and a data problem. So right now, for instance, we are engaged in this intense, very difficult exercise to say we've committed by year end, we want to put a temperature path on the entirety of the assets that we're holding on behalf of our clients. In other words, there's going to be a number by year end that says, when you take all the assets that we're responsible for, the 9 trillion, that's the temperature path they are on currently. And I won't give you an early release of this, but it won't take a genius to figure out we're going to be roughly where the kind of global economy is, which is somewhere between 3 and 4%. We need to get to 1.5%. We know that. That's what the scientists are telling us. I had a call with the Potsdam Institute last week. They're still saying that's the right benchmark, although I think there's some concerns about feedback loops and, is that still enough? But let's take that as a given for now. That's the recommendation of the scientists. And then then you start to break it down to asset classes and ultimately to companies, individual holdings of companies or entire portfolios of our clients. And you start to show to them, this is where you are currently. So we have a discussion with a client, a pension fund, and a sovereign wealth fund, an insurance company, and you tell them, this is where your portfolio is. You're currently on a 3%, let's say, warming path. You need to get to 1.5. And then, once the data becomes credible, the methodologies become credible, hopefully the methodologies become somewhat standardized worldwide, you then start to have pressure on individual companies to articulate plans on how they themselves, company X, are going to get from 3% to 1.5%. And that's what we talk about as shareholders when we say to the companies that we hold, you need to come up with transition plans. And obviously for some sectors, such as fossil fuel generating or driven sectors, energy companies, oil companies, that's a hell of a lot harder than it will be for a tech company. But that's what we're going to be doing over the next couple of years, articulating plans, a lot of data crunching, lots of analysis to determine how does a portfolio today measure up and what needs to happen in that portfolio or in that company in order for it to get to 1.5%, which is what the scientists tell us we need to get to by mid-century to keep global warming in check. So it's a vast, incredibly fascinating, but also very, very complicated exercise. And I think, again, Glenn, to come back to your question, I think this is an area where central bank expertise could be helpful. When I think of all our experiences back with the BIS, if you could galvanize the analytical powers of the central banks globally and say, help us, figure out the right way to measure temperature alignment on financial assets, I think could be a very useful contribution.
That's an interesting concept, the temperature of an asset, so to speak. Sounds like an exciting area for research.
It's not that different. Just one last comment. I mean, conceptually, it's very complicated now, but we did similar stuff on credit risk, on liquidity risk. These are all things that central banks have been profoundly engaged in analytically. Now we need to figure out what's the temperature risk of a particular financial asset. And that's the key exercise.
All right, okay. We have reached the end of the hour, so maybe I will ask both of you, maybe start with Sabine, if she has some parting words that you would like to emphasize in particular. You're extremely passionate about this. That comes through very, very much in your discussion.
Yeah, thank you very much. Maybe I would like to give raise a call of interest for everyone who wants to join the Network for Greening the Financial System. We are still lacking Asian and African members. So whoever listens now, think of it, and I will be and send me an email, and we'll get back to you. Thank you.
Thank you. Philipp, last word.
I would like to use my minute to commend Sabine. I was there at the very beginning with her on stage, and it was tough for her. So I think what she has done for the central banking world, particularly in Europe, has really been quite extraordinary. And so keep up the good work. And if any of you can help you know, Sabine's effort to make it clear that this is not about changing the price stability mandate of central banks. It's not about, you know, completely radically changing what we do as central banks. It's about being part of this historic transformation. You cannot be outside of this. You cannot remain unaffected. So thank you, Sabine, for the effort. And as I said, I'm hopeful capital markets are moving, and that makes it irreversible, except, you know, we need to, and I guess that's the other call to action, just keep up the pressure on governments to sustain their political commitment. You know, we were there once before in the 70s. There was a Swiss man, Mr. Schmidheiny, who wrote a wonderful book, and nothing really happened because it didn't result in government commitments. And that's what's key, because otherwise this capital reallocation cannot be sustained if suddenly the markets begin to think this is not serious in terms of the commitment.
Thank you, Philip.
Well, thank you, both of you. This has been a fascinating discussion and enlightening, and the call to action of our member central banks, so those who are listening, is also very important. So I'm glad that we at ASB have been a little bit of part to raise the awareness in the region and elsewhere about these issues. So again, thank you, Sabine. Thank you, Philip, for a really excellent panel discussion. Thank you.
Bye.
And that concludes our webinar. If you want more information about what we do at ASB and central banking, you have the URL code, and you can always email us for further information. Thank you and goodbye.